Welcome back to Squawk Box this morning. Joining us right now is Joe Zidle. He's chief investment strategist at Blackstone. I want to get your take, and we're going to try to get Larry Kudlow's take maybe in a minute, if he'll indulge us, on what Steve Leisman's been reporting all morning. This idea that potentially the Fed could actually pause as opposed to make an actual move, which I think is what the expectation is right now. If they do what Steve is saying they might, what happens?
I think it's going to present volatility to the markets, both in the equity and as well as credit. I think we would see downside in equity markets. I think we'd see spreads widen out. And the reason is because all year long, the market's been enamored with the Fed cutting rates.
Right.
And what they've done is ignored the fundamentals. The fundamentals being, number one, no profits growth, right? We're looking at third quarter earnings that might optimistically come in at zero on a year-over-year basis, on top of first and second quarter earnings, which were basically like zero on a year-to-year basis. So you've had very little fundamental improvement, yet you've had almost a 20% rise in equities.
But play it out. Your pal Mohamed Al-Arian says, I actually hope they don't hit
I thought his point was great about how central bankers want to pass the baton off to someone. The challenge is on the margins, we're starting to see cracks in the consumer side of the economy.
So you think the Fed has to move?
I think the Fed will move this time.
Whether they will, I understand you think they will. I'm asking you whether they should.
I think the Fed should stay on hold. I don't think they should.
So on
be
hold.
cutting.
So you're with Mohammed.
3.5%.
Maybe you might be with the Fed if Steve.
Yeah. 3.5% unemployment, a 50-year low in the unemployment rate, number one. Housing prices that continue to trend higher, number two. This is not conditions in which the Fed should be cutting.
You said how crappy earnings are.
Yeah, I don't understand.
Well, there's a difference between companies and the economy, of course, right? And so what we've seen with
there's some worry
trade
now.
Tariffs.
Usually people say the economy leads the market lower. There's now a view among some on Wall Street to say that the market's going to lead the economy lower. It's going to reverse.
That's a good question because the market's really been priced off of liquidity. So I don't know if the market's necessarily going to move the economy lower or not. The question becomes, can we talk ourselves into a recession? Maybe it's not going to be the market. Maybe it's CEO confidence.
What are the cracks in the consumer you see? I mean, I know yesterday was the first time in 7 months we've seen a dip, but we talked to Bill Simon, who used to run Walmart's U.S. stores earlier today, and he said, look, he's not concerned about that because that was largely gasoline and auto sales. If you strip that out, the rest of the consumer looks pretty good. Jobs market looks good.
I think the very leading edge of the jobs market is where you're starting to see these hairline fractures emerge. And I'll give you an example. Yeah. One of the number one things you hear from companies is that it's very difficult to hire qualified workers, right? Yep. The inability to find qualified workers. So if you can't hire people, you think you should be using your existing workforce more, but the number of hours worked is actually rolled over. So that suggests that beneath the surface, there might be something more systemic happening, like a little bit more of a slowdown than we've necessarily seen in the data. But the number of job openings has declined. Overtime hours have declined. The average hourly work week has declined. These things are the leading edge. Now, the unemployment rate itself hasn't moved higher. It's 3.5%, but that's a coincident indicator. It's the leading edges of employment that are suggesting that there are these hairline fractures.
But the earnings, I mean, we had some huge gains, and we've had some tough comps for a while now. But the gains were huge, and same with the stock market. The stock market's been flat for however long you want to measure it, after huge gains. So if you were a half-full guy, you would say just sustaining those trends, which were really quantum leaps to begin with when they happened, just sustaining those for a couple of years, consolidating those for a couple of years, and maybe eventually heading higher, that would be a win.
Yeah, and the two things I think secularly that are going to challenge corporate profits and make it more difficult to sustain those gains are, number one, I think we do see a backup in the 10-year Treasury yield. We hit a low of 1.5. We're at 1.7 and change. And I generally think that 1.5 number is probably the low that we're going to see. So I think a year like 2020, we could see the 10-year Treasury yield moving higher, and that becomes a little bit more problematic for profits. And then secondly, trade. I think it's too early to say that the trade war is over, and I think it's too early to say that we've rolled back the damage. And when you look at trade friction all around the world, it suggests that either, number one, profits are going to get hit, or number two, the consumer's going to feel higher prices.